The concept of earnings power. Unlocking true value in investments. Imagine having the power to foresee a company's true potential, to predict its future success, and make decisions that could change your financial destiny. This isn't just a fantasy. It's the essence of understanding a company's earnings power. Stay with us, and we'll reveal how to assess this critical metric, giving you the tools to unlock unparalleled investment opportunities. Welcome to Nouveau Riche Investor. Today, we delve into the concept of earnings power, a fundamental principle in value investing. We'll explore how to assess a company's earnings power, why it's crucial for your investment strategy, and how this understanding can lead to financial success. Benjamin Graham, the father of value investing, emphasized the importance of earnings power in his seminal work, The Intelligent Investor. But what exactly is earnings power? Simply put, it's the company's ability to generate profits over the long term, reflecting its true value and potential. Think of earnings power as the lifeblood of a company. It's the steady stream of profits that fuels growth, innovation, and shareholder returns. Assessing a company's earnings power means looking beyond short-term fluctuations and focusing on its long-term potential. To evaluate a company's earnings power, we need to consider several key components. Revenue stability. Look for consistent and growing revenue streams. This indicates a strong market position and the ability to maintain customer demand. Profit margins. Analyze the company's operating and net profit margins. Higher margins suggest efficient operations and pricing power. Return on assets, ROA, and return on equity, ROE. These metrics measure how effectively a company uses its assets and equity to generate profits. Higher returns indicate stronger earnings power. Competitive advantage. Identify the company's unique strengths, such as brand recognition, patents, or cost advantages that allow it to maintain and grow its market share. Industry position. Consider the company's standing within its industry. Market leaders typically have stronger earnings power due to economies of scale and greater influence over market trends. Graham taught us that understanding these components is essential for identifying companies with strong earnings power. It's about seeing the bigger picture and recognizing the factors that will drive long-term profitability. The true value of a company lies in its earnings power. It's the cornerstone of value investing, guiding us to make informed decisions based on a company's intrinsic worth. By focusing on long-term potential rather than short-term gains, we position ourselves for sustainable success. In conclusion, mastering the concept of earnings power is crucial for any serious investor. It's the key to unlocking true value and achieving financial stability. By assessing a company's revenue stability, profit margins, returns, competitive advantages, and industry position, you can make informed investment choices that lead to lasting success. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing.